I am not buying silver bullion. I have a fairly large position in gold bullion. By the way, I'm stupid to do that. I'm the largest shareholder of Sprott Inc. And if the gold market and the silver market run, in theory, the most important brand name for retail investors in gold in North America is Sprott, I will do well. But I own gold bullion because it helps me sleep nights. And at age 71, that's a real benefit. I do own silver stocks. And I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically, there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities. And the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s, when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65. In the latter part of the decade of the 80s, before that wonderful bull market that happened 91 to 96, I was able to finance 2 small silver companies. One, Pan American Silver at 50 cents. The other, Silver Standard at 72 cents. 6 or 7 years later, both of those stocks had crested through $40. So when I say that in a silver bull market, the asset class that performs most dramatically to the upside is silver stocks, that is an indication. I was vocally bullish about silver stocks in December of last year and January of this year, for the simple reason that there was so much hate concerning them on social media. I determined that from my own viewpoint, almost everybody who wanted to sell had sold, because there was no love, there was only hate. The consequence of that is that that subset of silver stocks has done very, very well, up about 50, 60% in the first, 7-8 months of 2024. In direct answer to the question, about 2.5% of my total portfolio was invested in silver equities. That has become about 3.5% of my portfolio, not because I've added more money to it, but simply because the prices of the small silver stocks has outperformed most other asset classes in the ensuing period.
You had mentioned a little bit earlier, or referenced this idea of legitimate mining companies. Is it fair to say that one should just think about the space from a blue chip perspective, like the best of the best, don't speculate too much on the smaller ones because some of them may not be as legitimate in quotes as others?
For most of your listeners, the answer to that is yes. If you look at a 50-year chart of the XAU, what you'll see is that the gold equities bull market is a truly spectacular thing. It is common that you experience a 300% share price escalation over 3 or 4 years. It's not uncommon to see a 500 or 600% share price escalation. So merely capturing the beta, which I would define as the outperformance of the gold mining sector relative to other sectors, is a very worthwhile endeavor if one has the patience to do it. You can accomplish that 2 ways. You can buy the index, you can buy the GDX, you can buy the XAU and capture that beta. But what I prefer to do is a little harder working, but a little more conservative. Rather than buying the top 40 companies in the sector by market cap in the form of an index, but exposing myself to 20 or 25 companies that I wouldn't otherwise buy because I think they're second tier performers. What I prefer to do is construct an investment account for myself to capture beta that is the best of the best. Ironically, in a rip-roaring bull market, the best of the best underperform the rest. The reason for that is obvious. If you are a low-cost producer, increases in the gold price increase your margin less than the margins of the less efficient producers increase. What I have decided, Michael, at age 71 is that for the investment part of my portfolio, you can take away some of my upside if you take away most of my downside. Let's assume that by buying 5 or 6 of the highest quality gold mining companies in the world, that I underperform the index by 15%, as an example. And Let's say that the market itself exhibits the performance in past gold bull markets, and the index itself increases by 300%. That generates for me perhaps a 240% gain, but a de-risked gain. That's good enough for me, Michael. It might not be good enough for others.
Is it generally safer to buy mining stocks in miners located in North America?
The price for political risk is a function of price. It is interesting. North American people, particularly North American people that look like me, believe that money that's stolen from them by obviously Caucasian people in English, according to the rule of law, is somehow less gone. My worst experience with political risk, personally, in terms of money lost, occurred in a banana republic called the People's Republic of California, where we made a gold discovery in 1982, and as a consequence of politics, weren't able to put that project into production until 1994, a 12-year delay. A 12-year delay at an 8% cost of capital means that effectively all the net present value of the deposit at the time it was discovered was gone by the time we put the deposit in production. By contrast, as an investor, although there have been thrills and spills, I've been treated well in places like Sudan, in places like the Congo, in places like Bolivia. It's really a function of the price that you pay for the risk that you experience. An investor who will cause himself or herself too much trauma watching the nightly news, seeing the problems that go on in places like Congo, and who will not psychologically be prepared to stay the trade. For the people who will pay more attention to the narrative than the arithmetic over time, those people, because of their own response to political risk, would be much better off investing in North America. But when I hear that North America isn't politically risky, I think about data like this, Michael. There's a wonderful copper deposit in Arizona called Resolution, discovered 3 decades ago, 1.5 billion tons of 1.5% copper. For reference, the average mined grade of copper worldwide is less than 0.5%. This is 3 times the average grade worldwide, and it's right in Arizona. It's next to a community that has miners. It has water. It has power. It has rail. It has highways. It has everything. This mine has been stuck in permitting in the state of Arizona for 26 years. 26 years. When people tell you that Arizona isn't risky, or California isn't risky, or Texas isn't risky, or British Columbia isn't risky, or Ontario isn't risky, they are not telling you the truth. They're a different set of risks. I'm tempted to say, Michael, this will disenfranchise some of your audience, the most dangerous government is the one that's closest to you.
Could you offer a view on concentration and diversification investing? Now, I remember this line that diversification is a luxury for the rich. The implication there, of course, being that if you want to get wealthy, you have to take a concentrated bet, which of course means that's also how you go broke.
Warren Buffett always says that the ideal number of stocks in one portfolio is 1. That you put all your eggs in one basket and you focus on that basket extremely well. I don't consider myself anywhere near as smart as Buffett. I would argue that diversification for me is partly a hedge against my own ignorance. I've never found an investment that was good enough that I had the courage to put all of my net worth into it. I certainly, from time to time, have seen circumstances where I thought that the investment proposition had so much going for it in terms of the probability of it working, and so much going for it in terms of the escalation of value that I would enjoy if I was right, that I made very, very, very heavy bets. Not as heavy as Buffett has, and the consequences that my results haven't been as good as Buffett's has been. But I believe in concentration when the time and when the bet is right. I believe in diversification because I have to diversify. I haven't yet seen an investment that I could go all in on. But let's return to the origin of that question, or rather the statement. I am, in fact, substantially more patient at 71 now that I have less time on Earth than I was at 21 when I had lots of time on Earth. That isn't because I wouldn't prefer immediate gratification. It's because as an investor for 50 years, what I have learned is that the most important thing in investing is compounding, and compounding takes time. As a speculator, One makes money answering a series of unanswered questions. So in my speculative portfolio, I did a fairly extensive back test, and I found that in terms of speculations that really made a difference to my net worth, speculations where I got 10-fold returns or 20-fold returns or even 100-fold returns, that my average holding period was 6 years. And by the way, in my average 10-bagger, I experienced at least one, but often two, 50% share price declines during the period that I held the stock. That means that you have to be A, patient, and it means that you have to be B, tenacious. I wish it wasn't so. I'm not being patient because I want to be patient. I'm being patient because my observations around the topic tells me if I'm not patient, I won't be rich. I have become patient simply because experience has told me that patience is what is required to generate spectacular capital gains over time. Warren Buffett, again, quote, "The ideal holding period is forever."
Do you think the recent uptick in I-80 gold was justified? And this is more the question that to me is intriguing. How much can a new CEO impact the value of a mining company? The leadership, it's supposed to matter.
Let's talk about both of those. The recent uptick in I-80 gold happened for two reasons. The gold price did well, but probably more importantly, the seller was gone. It's fairly well known that Equinox Gold was a 19% shareholder in I-80, and Equinox needed to raise cash to finish off a $1.2 billion construction project in Northern Ontario. If Equinox had raised capital in Equinox rather than selling their I-80 shares, the institutional investors would have said, oh, that's very interesting. You think I-80 is worth more than you are. One consequence of that is that Equinox sold the I-80 shares. In other words, a 19% shareholder had reason to sell the shares, had a need for capital, and did it. When there are more sellers than buyers, the share price goes down. The uptick in I-80 shares corresponds very nicely with Equinox Gold running out of stock to sell. Surprise, surprise. The second part of the question, can a CEO make a difference? A CEO can make all the difference. A CEO who makes intelligent strategic decisions, a CEO who manages his or her board while they're managing him or her, a CEO who optimizes the allocation of skills among the other senior managements on the team. What you find over time is that you have serially successful human beings. And those serially successful human beings in small companies like I-80 Gold become absolutely critical. For those listeners of yours, Michael, who are familiar with Pareto's law or the Pareto principle, which is the social science dictum around the popular cultural supposition of the 80-20 rule, 20% of the people adding 80% of the value, will understand the importance of the CEO. What's important to understand in the context of this discussion is that the 80-20 rule repeats itself, which is to say, if you believe that 20% of the population generates 80% of the value in any given endeavor, what you find is that if you take that 20 and run it through the same performance dispersal curve, that 20% of the 20 do 80% of the 80, or 4% of the population generates 64 or 65% of the utility. And I have found over 50 years in speculation that runs at least one standard deviation more, which is to suggest that 8/10 of the population generates about 45% of the value in any given circumstance. A high quality CEO, is proof that the effect of Pareto's law goes at least 3 standard deviations. And it's an incredibly important thing for investors and speculators to pay attention to.
Speaking about playing with the junior side of things, this one from Unite America Unite, not investment advice, but I think it's worth bringing it up. I want exposure to junior miners with less potential downside, don't we all? Is Empress Royalty a good vehicle for this?
I'm an Empress Royalty shareholder because I think that the company is selling for a little bit less than its royalties are worth. In other words, I think it could be liquidated at a premium to the current market cap. So my downside right now is an upside. One needs to understand that Empress Royalty is substandard. It is too small a company to, over time, withstand the general and administrative expense associated with building a royalty company. So Empress Royalty will have to grow, or else the cost of running the company will cannibalize the premium of value to market capitalization. I own the company because I believe the management team has access to deal flow that is superior to the access to deal flow that is exhibited by its competitors. Specifically, the management team comprised part of the management team of Endeavor Financial, which is one of the most important financing arrangers for juniors in the world. As a consequence of that, the Empress Royalty team, sees opportunities to acquire royalties and acquire streams that are proprietary, that don't get out into the market at all. I am of the point of view that Empress Royalty will be able to add sufficient mass in the next 2 years so that the cannibalization of the net present value by the G&A won't pull the company through the floor. This is a speculative position. People need to understand that. They need to understand that this durable competitive advantage with regards to acquisition doesn't result in scale additions over the next 2 years, that you will lose money. If I'm right about the durable competitive advantage and about the company's access to capital, including my own, and they are successful in expressing this advantage in the way that they have in the past, one could do very well. Understand that this is a speculation, not an investment. Understand, too, the conflicts of interest. This is a reasonably large position for me.